makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Private sector activity in the euro area's two biggest economies worsened at the end of the year, increasing the risk of a recession in the second half. Hungarian Prime Minister Viktor Orban says his government will not support a new European Union aid package for Ukraine until the bloc pays out all of the funds it's withheld from Budapest. Plus, our exclusive conversation with the Campari Group Chief Executive on the company's biggest ever deal as it buys Courvoisier Cognac. Now, let's take a look at the European markets map. Again, we're seeing a bit of euphoria across the board. Maybe not euphoria, but certainly we're seeing gains across the board. So the FTSE for the moment is unchanged, but the DAX is getting some 0.6%. The CAC 40 also getting a nice little lift. This equity's really holding on to gains after the Federal Reserve validated bets that it will soon move to easier policy and push stock market gauges towards all-time highs. Now, we are getting some data out of the euro area. December services PMI falling to 48.1. And now anything below 50 means contraction. The forecast was of a 49 number. And then if you look at manufacturing, so that was services. If you look at manufacturing, also below estimates, the forecast 44.6. It came in at 44.2. Now, we've had the ECB and the BOE reluctant to follow the Fed chair, Jay Powell's pivot towards rate cuts. The euro area central banker said that slowing inflation cannot be taken for granted.
We did not discuss rate cuts at all.
Clearly a topic of discussion out in the world and also a discussion for us at our meeting today.
No discussion, no debate on this issue.
Inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain.
Should we lower our guard? We ask ourselves that question. No. We should absolutely not lower our guard.
We still have a ways to go. No one is declaring victory. That would be premature.
Our past interest rate increases continue to be transmitted forcefully to the economy.
I think you can say that there's little basis for thinking that the economy is in a recession now.
The economy is expected to recover because of rising real income, as people benefit from falling inflation and growing wages, and improving foreign demand.
Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully.
Well, joining us for a look at the market moves following all of this central bank action is Jamie Rush, Chief Europe Economist at Bloomberg Economics, and Wei Li, Managing Director and Global Chief Investment Strategist at BlackRock. So thank you both for joining us. Wei, let's start with you. It's been quite a week for the central bank pivot. How many cuts are you expecting from the Fed?
Well, certainly the number of cuts that we should be expecting increases after the Fed meeting this week. The bigger picture is, though, that the Fed has essentially boxed itself in by not leaning against market aggressive pricing for rate cuts. This is a very unusual environment of heightened macro uncertainty. And instead of leaning against market pricing, the Fed actually added fuel to this immaculate scenario. It can still happen, but it's just so much uncertainty around it, and it boxed itself in. We think that greater volatility could come off the back of that. And also, certainly, we have greater conviction that inflation would settle higher and above target because of this pivot that we saw this week.
So, why does that mean you think markets are actually just getting ahead of themselves in terms of how many cuts they're expecting next year from the Fed? And so will they inevitably be disappointed?
Well, markets are currently pricing 6 cuts for the Fed, 5 cuts for the ECB, and 4 cuts for Bank of England. And those are numbers. Those are chunky cuts, even more dovish than what the Fed themselves are signaling, right? So there will be some sort of reconciliation through the course of this year. But for as long as the Fed is doubling down on this narrative, I definitely don't want to go against it. So from now until the year end, momentum is strong, even though the ECB and Bank of England were trying to push against it. Obviously, the Fed narrative dominated. If you look at yesterday's reaction, yields were falling, equities were going up, even as the ECB and Bank of England were trying to kind of push against market pricing. So for as long as the Fed is keeping up the narrative, we think that momentum can continue. But as this everything rally continues, it poses valuation challenges that definitely sets the stage for being more selective in the new year.
Jamie, what's your take on, and we were joking a little bit about this yesterday morning, the fact that, Jay Powell probably made the job of Christine Lagarde and, of course, of Andrew Bailey so much harder, but they really had to push back against that narrative that the fight against inflation is one.
Yeah, I think unfortunately for Bailey and Lagarde, I mean, markets are listening to Powell and they've responded pretty aggressively. They're not listening to Lagarde, they're not listening to Bailey. And I think it's a different emphasis. The Fed is looking ahead, right? So they're saying if we cut when inflation is at 2%, it will be too late. Whereas the Bank of England and the ECB are still very focused on the current outturns for inflation, for wage growth. And so they're being more cautious. But I think as we kind of get into the first half of next year, that narrative could change. And we could see that the ECB and the bank are starting to look further ahead. And therefore, that would, of course, be the thing that unlocks an earlier path for rate cuts.
Wei, was there always a bias actually in the markets expecting cuts? So was it? I know they were listening to what Jay Powell said, but was there always the kind of belief that cuts were coming, even when central banks were pushing back against that, including Fed officials?
Well, if we look back on 2023, there are multiple episodes where markets were just trying to read into whatever it can read into to support a more dovish narrative, only to be disappointed later, right? But the difference this time is that the pivot is pretty distinct, and the Fed is now talking about rate cuts. So the big picture is, as we look ahead to 2024, it will be a year of rate cuts as opposed to this year and last year that were defined by rate hikes. And against this backdrop, actually, cash has served us well, yielding 5%. But after peak rates, we got to think about putting money to work, putting cash to work, because in periods after peak rates, cash tends to underperform equities and bonds, which is why we're now keen to really think about the selective opportunities that we can take advantage of as we think about the year that is going to be characterized by rate cuts.
And so how do you take advantage of that in a market's perspective?
Well, right now, if you think about the very narrow market still, for example, in the US, as you know, Francine, we have been hiding out in tech and AI theme and barbelling that with front end of the curve. We lean into duration in Q4. We trimmed a little bit, but our current neutral allocation to duration still stands in contrast with the long-held underweight that we had for 3 years prior to Q4. So leaning into duration within fixed income inflation-linked bonds actually could start looking interesting now, especially given the pivot, giving us greater conviction that inflation would settle at a higher level. Within equities, while our tech and AI theme has served us very, very well, and we continue to have the overweight, but I cannot help but wonder the laggards, the likes of small cap, the likes of REITs, the likes of value, we're just waiting for the pivot that we saw this week to actually start to outperform, which we started seeing. But given the very meaningful underperformance that they have delivered this year, there is a considerable room for playing catch up. So again, this is more of a momentum type of play that may well be shorter than the horizon that I typically look at, which is 6 to 12 months. But momentum is really strong. So that together with the year-end technicals may well mean that there is more runway to go. The last thing I would say, emerging markets. Emerging markets central banks have been waiting for a notable signal like the one that we saw from the Fed this week. So emerging market valuation is attractive, and central banks already ahead of the curve with rate cuts, and now they could really be well positioned.
So, Jamie, talk to me a little bit about whether you've changed any of the calls, for example, for the Bank of England. I don't know whether it makes sense for them. I know the market is pricing in possibly too many cuts at the moment, unless they're also trying to cushion the mortgage market. So that would be quite a clever way if they bounce it right, to get it right.
Yeah, I mean, we have nudged our Bank of England call slightly forward, so we now think they'll cut in June. We had previously thought August, and really that's not because of the signalling from the Bank of England, but rather the change in the global mood music. And no central bank is going to be immune to the Fed cutting rates aggressively in the first half next year. So we have brought that forward. For the ECB, it will depend on the path of the economy. We are now seeing a little bit more weakness, as we saw in those PMI readings this morning, suggesting that perhaps the GDP is going to track a little bit lower than the ECB is suggesting. If that turns into a kind of pronounced or more visible downturn, that's going to bring market pricing in line with March potentially. So we're going to be monitoring the economy, monitoring inflation. We're looking for inflation to dip quite sharply in the first quarter of the year after rising in December. The ECB could quite reasonably cut at any point in the next 6 months.
Jamie, what's your take on ECB? Again, I mean, the press conference was quite masterfully in trying to navigate quite a difficult situation for Madame Lagarde.
Well, they were never going to be able to push back on market pricing. There's nothing that she could have said which would have changed markets' view. I think the way she articulated the decision around the first quarter was quite helpful. She kind of pinned the decision on data that wouldn't be even available until after the first quarter is over, which helps give a little bit of clarity on the kind of inertia that the ECB is likely to be involved with if the economy holds up over the next few months. But again, if things change, and if the PMIs really dip in the first quarter, then the ECB is going to be under tremendous pressure to cut. And if the Fed goes in March, then clearly there's a possibility the ECB does the same.
Thank you both for joining us. Jamie Rush, as ever, Bloomberg Economics, and BlackRock's Wei Li stays with us. We'll talk a little bit more about China, because coming up, China's central bank offers a record $112 billion of loans to commercial lenders, just as economic data from Beijing comes in mixed. Well, Wei Li stays with us to discuss that next, and this is Bloomberg. Well, the conversations that matter, the insights that you need. This is The Pulse. I'm Francine Lacqua here in London. Now, Asian stocks rallied today after China extended its support for the economy with the largest injection of medium-term policy loans ever. New data from Beijing, meanwhile, shows the economic recovery remains fragile amid a housing slump and weak demand. Well, still with us, Wei Li, Managing Director and Global Chief Investment Strategist at BlackRock. So, Wei, first of all, thank you for sticking with us, but how do you play China into 2024?
Well, it's really interesting. On the one hand, the market is cheap. It has underperformed broader equity market so far this year. On the other hand, sentiment is still really quite negative. And today's reaction to the announcement from PBOC is very telling, right? It's record injection of cash in the financial system. And yet, if you look at the onshore equity market reaction, last time I checked half an hour ago, Shanghai Composite, it already closed when I checked. So it was down 50 basis points on the day. And offshore market, the H shares market, they are up, they are getting excited. But it really speaks to how reluctant kind of onshore sentiment wants to react to any sort of support measures from central authorities. And this has been the theme through the course of this year. If you look at the latest data, industrial production was good, but retail sales was not so good. And this is illustrative of the muted consumer sentiment in domestic economy, which is in sharp contrast with consumer sentiment in the US, for example. So how do I play China? Currently, we are neutral. It's really a view that is, on the one hand, acknowledging the valuation opportunities and the potential support that could come from the central authorities, but on the other hand, just really recognizing structural challenges around growth headwind, demographic headwind. We're expecting 3% growth for Chinese economy by the end of this decade. Maybe in the very, very near term, we have kind of policy measures stepping up, generating some sort of excitement, but the structural trend is hard to fight back, and this is why we are neutral.
So, Wei, I mean, is there a danger that we're actually exporting, I guess, deflation across the world? I don't know whether, when you look at the pattern of inflation, what kind of influence China will have.
Well, PPI has been very weak for a long time. CPI is starting to also be weak, which is certainly kind of linking into some of the channels that we're seeing for the rest of the world. You look at Eurozone inflation that has surprised on the downside for 3 consecutive months. I wouldn't say that 100% kind of linked, but certainly this disinflationary pressure that we see in China is impacting kind of the broader global economy as well. On the one hand, it makes the job of central banks a bit easier because they want to fight inflation, and this is kind of feeding into that. On the other hand, for domestic kind of economy in China, this inflation is a challenge, is a difficulty that they need to address. Inflation falling, nominal profits, nominal earnings will be impacted, which is also why sentiment towards China so far this year has been very negative, which is also why it's soliciting all this response from the central authorities. But do we have the bazooka that markets need to really turn around? Maybe not yet. We have had very targeted, steady drumbeat of targeted measures, but not the bazooka that we saw before.
Wait, I mean, the other thing that seems very exciting for next year is Japan. And I've seen more and more calls actually being positive on Japanese equities. I don't know how you play Japan, whether it's some kind of carry trade or whether you play it in relation to something or you just go full in Japanese equities or else.
Well, we like Japanese equities. We upgraded it twice through the course of 2023, and we continue to have it as an overweight as we head into 2024. Earnings already have been revised higher. We think there is further upside even to the revised higher level. But of course, the risk here is that against the broader backdrop of developed market central banks talking about rate cuts, at least the Fed starting to talk about rate cuts, is there room for the Bank of Japan to exit its very easy monetary policy? And when it does that within a short window, does that generate additional volatility? We like Japanese equities on a currency unhedged basis for precisely this reason, because we certainly see yen having room to strengthen as it tries to exit its very easy monetary policy environment when the rest of developed market central banks are moving in the direction of rate cuts. So we like Japanese equities, but definitely on an unhedged basis.
Thank you so much. Wei Li, Managing Director and Global Chief Investment Strategist at BlackRock. Now, coming up, Viktor Orban says he will not support a new aid package for Ukraine until the EU pays out all of the funds withheld from Hungary. This is Bloomberg. Now to geopolitics, and European Union leaders have failed to reach an agreement on a new financial aid package for Ukraine, which continues to be blocked by Hungary. But a significant political victory for Kyiv yesterday when the EU unexpectedly agreed to open membership talks.
We will revert to this matter early next year, and we will try to get unanimity in order to make possible for us to implement this negotiation.
Well, for more on this, let's bring Bloomberg's Europe correspondent Maria Teresa. Maria, how significant are these two decisions for Ukraine?
Yes, Francine, and these are two decisions that took place yesterday. Obviously, we know one went through and the other one did not. But to go back into what was agreed, and that is the accession talks for Ukraine. This was hugely important for the country. In fact, Francine, if you go back to 2022, when Russia invaded Ukraine, one of the first things that the government of President Zelensky did was to apply for EU membership just days after the war started. This is hugely important for the country. It obviously cements what the Ukrainian government says is a turn to the West that the country wants to make. Just to give you some color, however, and perhaps, look, this is the magic of Brussels and the way a deal comes through. But we are told that Prime Minister Viktor Orban of Hungary, of course, you know that he was very vocal about this idea that he does not believe Ukraine is ready to open accession talks. But at one point, he was told by the German Chancellor, if you don't agree in principle, we understand that, we get that, but now maybe it's time for you to leave the room and allow everyone else to vote in unanimity. So Viktor Orban, at that crunch moment, decided to leave. That's how this deal came about. When it comes to the funding for Ukraine, and that is the 50 billion euros pledged over a period of 4 years, there is no deal on that. We know the European leaders were working past 2 a.m. in the morning on this. There are still questions about how to present it and how to formulate this cash. And on top of this, Viktor Orban maintaining a veto on the money specifically. So no for the accession. That went through. But when it comes to the money, the Hungarian prime minister says he cannot agree to it fundamentally. The question is now, what happens next when it comes to the money for Ukraine?
All right, Maria, thanks so much. And of course, Ukraine saying they need urgent funds. Our European correspondent, Maria Tadeo, on this very, very important EU leader summit. Now, coming up, our exclusive conversation with the Campari Group Chief Executive on the largest deal in the Italian drinks makers' history. We'll talk, of course, about some of the things that he sees going forward. We'll talk cognac, we'll talk valuation, and we'll also talk about how our changing habits will continue after COVID. This is Bloomberg. So private sector activity in the euro area worsens at the end of the year, increasing the risk of a recession in the second half. Hungarian Prime Minister Viktor Orban says his government will not support a new European Union aid package for Ukraine until the bloc pays out all of the funds it's withheld from Budapest. Plus, up next, our exclusive conversation with the Campari chief executive on the company's biggest ever deal. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, a little bit of data. We're hot on data, actually, this week. This is on the back of what we heard from the ECB president yesterday. And so we're trying to piece together exactly what kind of inflation we'll be left with, what that means for growth, and therefore what that means for central bank policy. Now, euro area December services PMI falling to 48.1. The forecast was of 49. So the latest for services, and then manufacturing is pretty much as expected, 44.2 instead of 44.6. We're also getting some UK PMI, so euro area we had. So we're just reminding you what that figure looked like. Euro dollar 109.63. And then the UK PMI is actually coming in, I think, as expected. Let's bring those numbers for you. If we have them, we should have them somewhere. We'll get back to UK PMIs. There you go. December manufacturing PMI, 46.4. The forecast was 47.5. Again, they're not great numbers because anything below 50 actually indicates a contraction, but 46.4 also missed economists' expectations. Now, Campari has agreed to buy Courvoisier Cognac from Beam Suntory for at least $1.2 billion. Now, the deal adds one of the major cognac brands to Campari's portfolio and is the largest acquisition in the Italian drinks makers' history. It comes as cognac makers face weakening sales, particularly from U.S. consumers after a surge in demand during the pandemic. Now, I'm now joined by Bob Kunze-Concewitz. He's Campari's chief executive. Bob, first of all, congratulations on a big acquisition. If you look at the share price, there's a lot of question on what happens to it. I'm unclear to me why the share price is down 3%. But what do you think the biggest challenge with this acquisition is? Getting the U.S. to consume more or actually premiumize a lot of the brands?
Well, look, first of all, this is a one-in-a-lifetime opportunity to buy one of the big four maisons of cognac. I mean, this really comes around only every 50 to 60 years. It's a perfect fit with our strategy because we've always said we want to buy aged premium brown spirits with a skew to the US and to Asia. And again, it is right out of our playbook, and this comes back to your question, is that we're pretty good at buying brands which have super latent brand equity, history, heritage, great liquids, but have been deprioritized and not really worked the right way by their previous owners. So we've shown time and time again that we're able to turn around those brands and get them growing again and premiumize them. Now, if you remember, it's very similar to when we bought Wild Turkey. At that moment in time, in 2009, bourbon was really an unexciting place to be, but we really believed in its long-term opportunities, and we bought a brand which was dusty. We turned it around, premiumized it, sexy. And bourbon is now our second largest leg and doing extremely well, and it's one of the hottest categories in the market. So we see a lot of parallels. And last but not least, this is the right moment in the cognac cycle to make such an acquisition. I mean, it's much better than buying when you're at the peak or when the markets are frothy.
So, but you think you got a good price for it?
We think we got a pretty fair price for it, yes.
And Bob, just talk to me a little bit about
how long a time. You need to bear in mind the
you
scarcity.
Talk to me a little bit about how long a time you think it takes to move consumers to premium offerings. So do you also have to age, or how much longer does a maturing liquor need to be laid down to get that premium price, or is it about marketing and selling it differently?
The great news is that we're acquiring a fantastic inventory, which is very well balanced across the different types of liquids and age profile. So there's zero limitations from that standpoint. It's going to be much more of a marketing and a sales exercise, and this is our bread and butter.
Bob, talk to me a little bit about the secret sauce of actually, again, premiumizing brands. I know it's collaborations. I know it's kind of also the cool effect. Is it harder now than it was in the past, or is it just the same pattern that you can repeat? You're also leaving in a couple of months. So what kind of advice do you give to the person that takes over?
Well, in brown spirits, the secret is actually lies in innovation, and that's what we did with Wild Turkey. We really innovated up and stretched the brand. When we bought it, it was actually ending at $19.99, and now we're at $450. So if you have the liquid, in Wild Turkey it took a little bit longer because there wasn't much of an aged inventory. Here we have it, so we can act very, very quickly. But at the end of the day, what really counts also is having authentic brands with history. I mean, this is one of the most awarded brands in the category. It's actually the most awarded one. And it is widely recognized for fantastic liquids. Now what we got to do is get liquid to lips and make the consumer dream about the brand again. With regards
Bob,
to advice to my successor,
Yeah, I was going to ask you.
Well, look, the CEO is changing, but the team is the same, and the capacities and the capabilities we built over the years are there. So it's a very, very strong team, and we've really built a scalable model. The company is able to handle now a much, much larger and more complex, let's say, portfolio of brands. So we're in a very good position. At the end of the day, our business is about brands and people, and it's people who build the brands. So really my advice is let's keep on, that very strong Campari culture, the Camparistas motivated and really focused on the priorities.
Bob, talk to me a little bit about, you've seen Campari change in so many ways over the years. You also steered this group in the midst of COVID, where a lot of bars were locked down and you've had to repivot and rechange. Where do you think the biggest challenge will come from in the next couple of years? Look,
I think, first of all, we're very, very well positioned from a category standpoint. We're right in the hottest categories, in bourbon, in tequila, in the aperitifs, and we believe that, as of next year, cognac is going to normalize and come back. So we're very well positioned from a category standpoint. Our marketing model is pretty unique. We got to make sure that we stay, obviously, always one step ahead of the competition. And we'll see, the biggest question marks is always what's happening on the macro geopolitical level, and that is not anything we try and control. So I always tell our folks, there's a lot of market share to be taken from competition, and just let's focus on that. Yeah.
And I know we've spoken about supply chains, even onshoring, friendshoring, whatever you want to call it. Is it getting easier for drinks companies?
Yes. I mean, we're back to normality. During COVID, we had such an increase in demand that all of our brands were on allocation. Now, our supply chain colleagues have done miracles. We've basically doubled or tripled our capacity across all of our core categories, and doing that, whilst the plants were still running. It's almost like doing, heart surgery while you're running a marathon. But they've done a great job at that, and we're in a perfect position. You know, a case in point, next year, Espolón, our tequila, becomes a global priority because now finally we have more than enough liquid to go around on a global scale.
So as our tastes are changing, I don't know whether there's, you know, a higher spirit brand or spirit that you think will be the future as I guess we try and become more healthy, or actually our tastes are less sweet.
Well, look, over time, you know, the trend is very clear. People will drink less, but will drink better. And that means premiumization is the name of the game. And that's where, for example, an acquisition like Courvoisier comes into the game. If you look at the big trends, you either have the higher ABV classic cocktails or the single malts and the whiskeys and cognacs of this world, or you have the lighter ABV or no alcohol, and that's where we play with the aperitifs as well as the Crodino non-alcoholic aperitif brand.
And Bob, a final question maybe on where you see the biggest strength. I know you kind of track the economy in terms of people, you know, feeling good enough to spend on drinks either at home or in bars. We are going into the crucial Christmas season. When you look across the world, is the U.S. that much stronger, the U.S. consumer, compared to anywhere else?
Absolutely, absolutely, and particularly the on-premise, where we over-skew. So we're very happy on how we're trending in the U.S.
Thank you so much. As always, Bob Kunze-Concewitz, Chief Executive of Campari, stepping down in a couple of months, but he will come back on air to have a lengthy interview on how he sees the changing world, of course, of alcohol. Coming up, British Prime Minister Rishi Sunak heads to Rome to meet his Italian counterpart. We'll discuss the significance of the meeting. That's next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, the British Prime Minister Rishi Sunak is staking his political future on a proposal to send refugees in the UK to Rwanda. This weekend, Sunak heads to Rome, where he'll meet his Italian counterpart, Giorgia Meloni, who has a similar plan to send as many as 36,000 migrants to Albania. Now, for more on this, I'm joined by Bloomberg's Alessandra Migliaccio in Rome. Alessandra, it's a pretty unlikely, I guess, friendship or closeness between the UK Prime Minister and the Italian Prime Minister. What are they actually, discussing? Is it to get something done in terms of business, or is it just to show Europe that they're allied on this?
Hello, Francine. Thank you for having me. Yes, I think definitely they're just trying to show a united front. I think they both need allies for different reasons. I think Rishi Sunak sort of needs to position himself a little bit more on the right just to get those extra votes, that extra consensus. And Meloni, on the other hand, ironically, just the other way, she needs to be more center-right because she's looking towards European elections next year. She wants to sort of be the leader of a kind of a center-right. So she's repositioning herself as palatable, as non-fascist, because as you know, at the beginning, she was seen as this very, very right-wing candidate. And the more she goes on in her presidency, the more she's presenting herself in that way. That said, this is a pretty crazy plan. Whether it's Rwanda or Albania, we don't even know if these plans are legal. We know that the courts, in both cases, different courts are opposed. So is this even feasible? We don't know, but it's something that politically is giving them extra points, let's put it that way.
So, this is a great point you make, right? This conference previously attracted hard right figures like Trump, Orban, Steve Bannon. So how much of a surprise is it that the Prime Minister of the UK is showing up?
Well, it is a surprise, really, and then it won't just be Rishi Sunak. It's a very interesting thing because we're also getting Elon Musk coming. She's invited kind of a very diverse bunch, and it's no longer this conference has been going on for at least 20 years, if not more. It's no longer that. It is now sort of more of a center-right event where she's also inviting members of the Italian opposition, and it's really, though, a way to sort of showcase her party, her power, her international clout, or what she perceives it or wants people to perceive it as, and it's just a way for her to position herself politically because there are European elections coming up, because she wants to increase her power base in Italy as well.
So, Alessandra, talk to us a little bit about the Albanian plan. I mean, how feasible is it, and what's being talked about in Italy?
So the Albanian plan is another crazy thing because, why am I saying that? Because you would be taking, from what we understand, families off these ships. So in the sea, in the high seas, you will be separating families likely because it's not legal to take minors. Pregnant women would be separated, maybe all women even in some, depending how you interpret the law. So you'd be taking these men to Albania, separating them from their families, which again, possibly legal, to where? To an enclave which would be run by Italians, but the security would be managed by Albanians. Again, is that legal? Albanian courts are saying perhaps not. Will it ever happen? We don't even know if this will ever really happen. But the announcement has gotten her a lot of brownie points, in Italy, in polls, and I think that's really what she's looking for. She's done this before. She's announced things that then never happened, but it's gotten attention.
Thank you so much, Alessandra Migliaccio there in Rome. Now, Bloomberg has also learned that Ethiopia's government is aiming to conclude a deal with bondholders early next year. This comes after it missed a $33 million interest payment on a Eurobond earlier this week. Well, joining us now is Bloomberg's Ondiro Oganga. Ondiro, thank you for joining us. So first of all, how did Ethiopia actually get into this position?
That's an interesting question, Francine, because a couple of years back, Ethiopia was one of the most promising economies in Africa. And today they're where they are. Here are some of the things that led up to this. One, there was a civil war for 2 years leading up to November 2022 that claimed lives, affected livelihoods, and also negatively impacted investor perception and confidence in Ethiopia, a country that is in dire need of that kind of investment and perception. And again, there was also COVID-19, the immediate and aftermath effect. The economy is yet to recover. And finally, liquidity challenges. Businesses, both local and foreign, have spoken about the challenges that they have with access to foreign exchange, thus putting a strain on their day-to-day operations. All this took a toll on the government. They went to China. They said, can we get debt relief? Which China gladly obliged. And so the government sees that if we're not paying one creditor, it's only fair that we don't pay everybody. I mean, what's good for the goose is good for the gander.
So what happens if they actually fail to make that payment?
A couple of things will happen from this, Francine. One of the things that would happen is investor perception is further going to be negatively impacted. And this is not good because those who have their money there might think of getting it out, and those who wanted to invest there might hold on until they see how things go. This will put further strain on their constraints with FX, and also we are likely to see their currency maybe depreciate. We are highly likely to see inflation rising and also the cost of living. Another thing that is likely to happen is lower credit rating. Already Fitch has said that if they don't honor their debt obligation by the end of their grace period, then they're going to be downgraded to restricted default.
And so how did the latest call with international bondholders actually play out?
Well, for once, they have good news. It went a little bit better than the previous call because the previous one with investors broke down. But this time around, we're understanding that they came close to concluding a deal early next year that will see the terms of restructuring the Eurobond of $1 billion come to a close. This is good news for them, but then again, it comes with its own set of challenges. Investors had issues with the technical nature of their payment, and also there were issues with the IMF program. The sooner they get it rolling, then the sooner they can have parameters of restructuring their debt. So this is something that we're just waiting to see how it unfolds, but hopefully next year we begin to see some movement.
Ondiro, thank you so much for joining us. Ondiro Oganga there in Kigali. Now, coming up, China's central bank offers a record $112 billion of loans to commercial lenders, just as economic data from Beijing comes in mixed. So we'll have all of the details next. And this is Bloomberg.
As I've said before, America's fundamental economic strength means that we have nothing to fear from healthy economic competition with China or any other country. I and other U.S. officials have repeatedly stated that the United States does not seek to decouple from China. This would be damaging to both our economies and would have negative global repercussions.
Well, that was U.S. Treasury Secretary Janet Yellen, who says she plans to visit China again next year. Well, this morning we have had data out of China showing industrial production beat expectations, but retail sales fell short, putting more pressure on Beijing to boost growth. Meanwhile, the PBOC has also offered a record cash injection via its medium-term lending facility. Well, joining us for more is Bloomberg's Sofia Orta-Acosta. Thank you, Sofia. It's been too long, actually, since I've quizzed you about China, because you understand it like no one else. What are your key takeaways from this China data dump?
So a little bit of a mixed bag when it comes to economic data. I am looking at retail sales, though. That miss there is important because, you know, even though consumption is not a huge chunk of the Chinese economy, it's where the problem really is. It shows weak domestic demand, falling short of estimates really shows also why there's a deflationary problem in China, really the opposite problem of most economies in the world. You know, CPI, the data that was out a few days ago also showed, you know, it's negative territory. Really a problem there, that Beijing is struggling to revive confidence, revive spending. And what I'm looking at is, you know, it's a bit tricky, I think, because whenever you look at this economic data, the weaknesses, the pockets of weaknesses there, Beijing doesn't really have that many tools to address this right now. And we're looking at, you know, Francine, you mentioned the MLF, the medium-term lending facility. Well, that actually is China almost recycling money throughout the financial system because it's feeding money into the banking system. Banks then use this money not necessarily to lend, because that would be good for the economy, but actually to buy government bonds. They're the biggest buyers of government bonds, and then that's used for fiscal stimulus. So it's, you know, it's almost like the government lending to itself in a kind of circular way. And we saw very weak credit growth data earlier this week. So there's clearly not demand from households and corporates to borrow. So we're in this problem. I mean, I do think the new state does show some resolve from Beijing to address this problem, but it also shows that the problem is perhaps more severe than feared.
All right. Thank you so much, of course, Sofia Orta-Acosta. We're just getting some breaking news, actually, from the Hong Kong Exchange, naming Bonnie Chan as the chief executive, replacing the former chief executive. So we'll try and dig a little deeper into what Bonnie Chan has been doing, if they've also said anything to do with the exchange, possibly how they also want to maybe change some of the way they operated. Just 2 days ago, we had a great conversation with the NASDAQ co-president to have an idea of what he was going into, now really saying that he wants to be seen as a technology company instead of just an asset or, you know, transactionary kind of company. Up next, Bloomberg Brief. This is Bloomberg.